What's more important, the swing or the clubs? In this educational episode, I'm going to talk about the difference between financial strategies, which could be compared to the swing, versus financial products, which is the clubs, the commodity. There's a huge difference, and I'm going to explain why you should be focusing more on the swing instead of the clubs. Get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for nearly 5 decades, helping people optimize assets, minimize taxes, and empower what I call their authentic wealth. Well, I've noticed that a lot of people, when they would come to me through the financial dimension, is what we call it, trying to understand how to best save for retirement, not outlive their money. And many times they never came to me until just a few years before retirement, thank goodness, because at retirement planning is something totally different than maybe what you should have done, all along, but it's different than what you did for retirement. So at retirement planning is very critical, and oftentimes it requires that people learn how to get money out of those IRAs or 401ks with the least tax impact and reposition it to vehicles that are going to be tax-free from now on and so forth. And so these are called strategic rollouts, which is a topic that I explain on this very channel. But in this particular episode, I want to differentiate between, a swing and the clubs, because if you were going to be playing in a golf tournament, let's say, and you had the choice of using a professional golfer like Phil Mickelson's swing, or you could use his clubs, what would you choose? Well, I'd rather have his swing, not his clubs. I've noticed that most financial advisors seem to focus on the clubs or the commodity. Buy this mutual fund or the stock or bond or gold or silver. It's not in the commodity. It's not in the clubs. It's in the strategy or the swing. And so this is why it's so critical to understand the difference between strategy versus a commodity. So I'm going to give you an example right now. See, a lot of advisors, they simply don't know what they don't know. And so when they hear me talking about one of my favorite financial vehicles that allows you to accumulate your money tax-free and then be able to access that money tax-free, and then when you ultimately die, it blossoms, increases in value, and transfers income tax-free. And by the way, nothing else in the Internal Revenue Code that I'm aware of does that. And the only vehicle that does that in the Internal Revenue Code sections 72E, 7702, and 101A is a properly structured, max-funded, indexed universal life insurance contract. And if it's structured correctly and funded properly, I deem it a laser fund. Laser is actually the title of my 11th best-selling book that's been flying off of our warehouse shelves. And I want to gift you a copy of this at the end of this episode. So stay with me here. Now, laser means liquid assets safely earning returns. It's an acronym. Now, it's tax-free, and it's really the best vehicle to participate when the economy, the market is doing well, going up, but not lose when the market goes down. So let's just dive in on that particular aspect of indexed universal life. It was introduced in 1997. And so this allows you to be able to participate when the market goes up. Let's use the S&P 500, Standard & Poor's 500. It doesn't matter if it's the Dow Jones or the Barclays, whatever index you're looking at. You can use several of them. But let's use the worst decade, or actually 12-year period, the Great Recession, since the Great Depression. We're talking about the turn of the century, 2000 to 2012. Now, people who have their money in the market. So let's say you had your money in an indexed fund, the S&P 500. An indexed mutual fund, your money is still at risk in the market. Why am I telling you this? Because a lot of advisors make the mistake of thinking indexed universal life is just a life insurance policy that is investing your money in an indexed mutual fund. No, okay? An index fund is the commodity, a commodity. Indexing is a strategy. It's a swing, not a club, okay? So the S&P 500, if you had $1 million that you had saved in tax-deferred IRAs and 401ks, in the market by the year 2000, you were preparing to retire, and you thought that $1 million nest egg could generate, 60, 70, 80, 100,000 a year of tax after-tax income. Think again, especially if it was in the market. What happened in 2001? September 11th, 9/11, the terrorist attacks. Well, from 2001 to 2003, the S&P 500, the economy, dropped about 40%. That $1 million nest egg for most Americans would drop down to about $600,000. Now, some people say, well, mine was worth more than that. Well, that's because you added money. If you didn't add any money, the $1 million went down to about $600,000, and people felt like they had lost their future. They had to put off retirement 7 years. And finally, 4 years later in 2007, it came back to break even. They finally had $1 million again. And so a lot of people sighed and said, okay, now I can retire 7 years later than I thought. And then what happened in 2008? As Warren Buffett put it, he said, when the tide went out in 2008, it revealed who was swimming naked, is the way he put it. Yeah, people weren't protected from market volatility, and they lost 40% again in one single year. And it took 4 more years until 2012 for that million that dropped down to 600,000 again to come back to $1 million again. Now, during that 12-year period, people who used indexing, indexed universal life, many of them, that million in 2000, had doubled and even tripled to 2 and 3 million at the end of 2012. I had many clients that the million was worth 2.5 million, even 3 million by using indexing, the swing, a strategy, and by rebalancing, which is another strategy. That's not a commodity. And so there's a huge difference between the swing and the clubs. People who simply use the clubs, an index mutual fund, they had to put off retirement 12 years. They were subject to the market volatility because they were in an indexed fund. A lot of advisors don't understand that when I talk about indexed universal life. No, when your money is in an indexed universal life insurance contract, it is not invested in the market. Your money is safe in the insurance company. And that $1 million during that 12-year period, the general account portfolio rate of most of these insurance companies was around 5%, some of them 6%. So during that decade, if the insurance company was earning on your money, just like any financial institution, 6%, they need about 1 of those percentage points for them, for their profits. They're in business to make money, and they would net you 5%. So really, index universal life is a strategy where anytime you feel bearish about America, you can just settle for the 5%. Your $1 million, they'll pay you 5% or $50,000 that year in tax-free interest. It's tax-free. But any year you feel bullish about America, which after the 9/11 terrorist attacks and the market went down for 3 years, I told my clients to link to an index, okay? And even when it started down, I had them just settle for the 5%. But then I said, link to an index. And so they linked, and what you're doing is telling the insurance company, don't invest my $1 million in the market. Keep it safe in the company earning 5. But I am relinquishing the 5%, the $50,000. You can do whatever you need to with that money to have the wherewithal to pay me whatever the market does. And so the insurance company uses that $50,000 to buy upside options, in this example, in the S&P 500. So if the S&P goes up 12, they'll pay you $120,000. If it goes up 16, they'll pay $160,000, which they did in 2009. Most of our clients got 16% returns that year. But see, if you guess wrong and the market goes down or crashes, you don't lose your $1 million. Your principal is safe. The options expire worthless. You don't make anything, but you don't lose. And so during that period, when the market went down in 2008, our clients may not have made anything much that year, but they didn't lose. And the first 90 days of 2009, many of them locked in gains of 16% after not losing a dime in 2008. This is how many of them, they made money when the market went up, but they did not lose when the market went down. They just stayed at break even. Whatever they started with when the market headed down. That's called indexing, which is a strategy. Is this making sense? So if you want to learn more about how to employ strategies instead of buying commodities, this mutual fund or that investment or gold or silver, folks, it's not in the commodity, it's in the strategy. So I want to gift you a copy of this book, The Laser Fund. Simply go to laserfund, laserfund.com, or click on the link below. And this retails for $20 on Amazon. You're welcome to buy it there, but I'll pay for the book. You contribute a nominal amount towards the shipping and handling when you go to that website, and I'll cover the rest of that cost, and I'll pay for the book. I will fire out a hard copy to you, but when you're in there claiming your free copy, check out, if you like to listen and learn, watch and learn. There are educational webinars that are free that we teach on a regular basis. You can even schedule an appointment to talk to an IUL specialist to see how to properly structure a laser fund, an indexed universal life, to perform the right way so that you're learning the swing. And they'll show you how to structure the clubs, but it's not really the clubs that matter, it is the strategy. So this is about you and your serious cash for your retirement. So go in, claim your free copy of the Laser Fund, and I'll see you on the brighter side of your financial future.